So continuing with bond valuations topic, this is unit 8.2, and in this unit we will discuss changes in bonds value over time and the calculation for the holding period return. So in this diagram, you can see that there are time paths of the 7%, 10%, and 13% coupon bonds when the market interest rate remains constant at 10%. So before we start to begin discussing this topic, I want to tell you some things about a bond. Usually when a bond is issued, so when a bond is issued, it usually trades at the par value. That means the coupon rate is equal to the market interest rate at that time. But after some time period, the market interest rate keeps on fluctuating, whereas the coupon rate is fixed. So that means that if a 25-year bond maybe has been issued, then 10 years later, 10 years later, the market interest rate may have increased a lot and the coupon rate is still the same, but the market interest rate has increased a lot. Then if that is the case, if market interest rate has gone up and the same coupon rate is being offered, then the bond price will go down for this bond. So even though the bond is still the same, but the characteristics of the bond are the same, it's still offering the same coupon rate, but because of that, the bond price is going to go down. Similarly, if the market interest rate decreases during that time period, making the coupon rate higher, then in that case, the bond price would actually increase and go and become a premium bond. So this is something that does happen in the market on outstanding bonds, that the bond price can deviate a lot from its par value over time. But as it approaches maturity, it will start to converge back to its par value once again, as you can see from this graph. So there is a bond that has a coupon of 13% and the yield to maturity, the market interest rate is 10%. And it is assumed that it will remain constant during the whole duration. So over here you can see on the horizontal axis that right now n is 15 and then n has decreased to 12, then 9 and then 0. So at 0 the bond will mature. And the bond value right now, this bond is 1250 and it will keep on declining, and it will reach 1000 at the end. Similarly, the other coupon bond, which has a coupon rate of 7%, now because the coupon rate is less than the market rate of 10%, the bond is trading at a discount. So it's trading at 750. But with time, as time goes by, as it nears its maturity, the bond value will keep on increasing and reach its par value in the end. Similarly, a bond that is already at par value, which is if it's offering a coupon rate of 10% and the market rate is also 10%, then the bond is trading at par and will continue to do so till its maturity. So over here in this diagram, it has been assumed that the market interest rate is not going to change for the next 15 years. If it is changing, then this graph will also not look like this actually. It is going to change because the bond price is going to keep on fluctuating as well. So the key takeaway from this is that while the prices of the 7% and 13% coupon bonds, they move in opposite directions over time, each bond will actually provide investors with the same total return of 10%. Remember, yield to maturity is the total return that your investor will earn if you hold the bond till maturity. So if the investor keeps the bond with them till maturity, they are going to earn a total return of 10% regardless whether they have the 13% coupon bond or the 7% coupon bond or the 10% coupon bond. The discount bond, which has a lower coupon and therefore a low current yield, it will provide a capital gain each year. So the low coupon rate is being compensated by the fact that the price of the bond is going to increase every year. There's a capital gain over here. As you can see that the bond price is going to keep on increasing. Whereas the bond which is right now trading at a premium, the price is going to keep on declining. So there is a capital loss every time, even though it's offering a higher coupon rate. The discount bond has a low coupon rate, but it provides a capital gain each year. In contrast, the premium bond has a high current yield, but it has an expected capital loss each year. So they are going to net off, and in total, your investor will get the 10% return. So the investor's total return is going to be into maturity if he holds the bond till maturity. So that is the return that the investor will get, the return of 10%. So moving ahead, now let's look at the holding period return. This is going to be an example. Wait, let me just pause this. So the holding period return is basically a return for the duration of the time that the investor holds the bond. So the investor is not going to hold the bond till maturity, but he is going to sell the bond before the maturity. So because he is going to sell the bond before the maturity, you have number one, the coupon payment over here. So that is till the duration of the time the bond is with the person is going to receive the coupon payment. Plus you have the capital appreciation part of it, which is the selling price minus the buying price divided by the buying price. So the return, the total return for the investor will come in two forms, the current yield and the capital appreciation part. So let's look at an example of how to use this return. But remember that holding period return will be used to estimate that what is the investor's return for the time period that he holds the bond. So he's going to sell the bond at some point. So the question is at a 9.3% annual coupon bond. So I'm going to write the data. The coupon rate is 9.3% with a 10-year maturity. Let me write this once again. Okay, so the N was 10. YTM is 8%. Assuming that the yield curve is flat and doesn't shift. This sentence over here simply means that your yield to maturity is constant, it is not going to change. Calculate the holding period return you would achieve from buying the bond and holding it for 1 year. So you're going to hold it for only 1 year, and after 1 year, you're going to sell it to somebody else. So that means you, in order to use the holding period return formula, you need the coupon payment, you need the selling price, minus the buying price, which is the price at which you bought the bond, and then you have to divide it by the buying price. It's easy to calculate the coupon payment, and you will just get 1 year's coupon payment. So the coupon payment is the coupon rate multiplied by the face value. Now in this question, you can see that the face value is also not mentioned. So when if ever that is the case, you can assume that it is 1000. So we're going to assume that it is 1000 multiplied by 1000. So this is 93. So the coupon payment is 93. But now you need the selling price and the buying price. How to calculate that? So you need the price of the bond. So there is only one bond valuation formula, which means you will have to use that formula only. So let me just move ahead. So first we are going to calculate the buying price, which is the price right now. So bond valuation, this is the formula. The coupon payment is 93. The R, what was the R? It was 8%. The maturity of the bond was 10. So you're supposed to solve this. So if you solve this, the buying price, the price of the bond at time 0 is going to be 1087.23. 1087.23. This is the price at which you will have to buy the bond. This is the bond value right now at time 0. Now, 1 year later, you're going to sell the bond. So the total maturity of the bond is 10. So 1 year later, right now the bond value is 1087. 1 year later, you want to know what is going to be the bond value at the time that you're going to sell out this bond. So for that, you need to know the bond price 1 year later. In order to calculate that, you need to still use the same bond valuation formula, which is the coupon payment is still the same, 93. That is not going to change. The interest rate is also the same because it was said that the yield curve is flat and will not shift. So this is going to be 0.08. Now the thing is that what should be the N over here? That is what you should think about. What will be the N value in the formula? The face value is still 1000. But what should be the N? Remember, N represents the remaining life of the maturity. So 1 year later, if you're calculating the bond price over here, the remaining life of the bond will be 9 now. Yes, so if you're going to sell the bond over here, somebody else is going to purchase the bond at this point, and you have already taken one coupon payment. Out of the 10, one coupon payment you have already received. So now the person who is going to purchase the bond from here, he will receive the coupon payments from here onwards. That means he will receive 1, 2, 3, 4, 5, 6, 7, 8, 9 coupon payments because you have kept one coupon payment. So for this investor, the investor purchasing the bond at this, the future cash flows, the future coupon payments are just going to be 9. So the N will be 9, which is the remaining life of the bond. So if you can do the calculation for this, 1081.21 is the bond price 1 year later. So that means you purchase the bond for 1087 and you're going to sell the bond 1 year later for 1081.21. So this means that you have a capital loss over here. 1087 is the price 1081.21 over here. So this is a capital loss. But you still will get 1 year's coupon payment. So everything is not going to be in loss. So now we can put the data in the holding period return formula. So the coupon payment was 93, the selling price was 1081.21, the buying price was 1087.23, and if you calculate this, your holding period return is coming 8%. So this is the return that the investor will get if he holds the bond for 1 year only and sells the bond to somebody else 1 year later.